Not this morning.
No, not today.
No, not today.
Okay. Well, let's see. Let's go ahead and welcome everyone to Saturdays with Eddie. Today is Saturday, January 21. It's about 11 o'clock Eastern time, or a little bit after that. And what we're doing here is talking about options. That's mainly what we do, options trading. We trade on the major stock markets here in the USA. So today is special for me because I'm actually leading this session from Nairobi. As you can see, what direction do I move? That way or this way? There we go. So you can see right, no, this side. Yep, that's where I am today. And so it's a lot of fun. You can do it too. You can travel around the world and still stay connected, still trade. Tested it 1,000 times, it works. And that's the message, and that's cool. So what are we doing today? It's for educational purposes only. I am not a financial advisor. That means that any strategies that we discuss today are simply for educational knowledge. If you do try them, remember that you can lose money. You can also make money. And because we're talking about options, which are leveraged, we are referring to, or we are talking about opportunities here to either make a lot of money or lose a lot of money real quick. But what we do is we try to be intelligent about it and incorporate some risk management. We're really big on risk management. If you are not protecting your money, you probably should stop trading. If this is a hobby, good luck. Good luck on that. But I think most of the people who are here are looking for a way to improve that bottom line, the P&L. So with that, welcome. No question is dumb. You just go ahead and blurt it out. Ask, find a good stopping point and ask the questions. I welcome those. And by the way, that's not rude. It is welcome. So just go ahead and stop me, ask the question. It's okay for as long as we are, talking on that. If we have the time to answer it or the opportunity, we will do that. And you'll get a lot of answers from a lot of people. So we're still building the topics over here. So because this is kind of like an open mic kind of deal, sounds like some people would like a refresher on the platform. Now, when we say platform, we're talking about Think or Swim. It is also possible that you're still using TradeStation, in which case we wish you well. We wish you well. We know that TradeStation is a great program, but it is, what's a nice way to say it, Byron? What's a good way to say it? It's character building. Yeah, it's character building. If you're still using TradeStation, then that means you're really, really strong. But there's still ways to make money. Incidentally, not to say that it's a bad program. I do actually use it, but I want to emphasize that once you understand the fundamentals of options trading or whatever kind of trading that you're doing, the platform really doesn't matter too much. It does matter, but not too much. It shouldn't stop you from getting or hitting your objective. So if that's what you have to use, by all means, learn how to use it, right? Take a bit of extra time to figure it out. So that's what I would say about platforms. Otherwise, you can use anything you like, right? Anything you like. So welcome everyone. Any questions before we dive in or get started? Any questions? Any comments? Anybody here for the first time and they want to say hello? And anybody here for the first time? Let's see. I'm seeing some faces here or some names that I'm seeing for the first time. Hey, Dami, is it Dami? How do you say that? Go.
Morning, Dami.
Dami, how's it going?
Good, thank you. So this is my first time here.
Welcome.
Yeah, thank you.
Cool. What brings you here? What are you looking for, Dami?
Knowledge. No, I just want to learn from everyone.
Okay, you're looking for knowledge. I was going to send you a link, but
just to learn from everyone. That's it.
Awesome. We love the humor, so bear with us there, Dami. Cool. Dami, have you traded options before?
Yes.
Okay. All right. So you're an optionista. That's
No,
awesome.
I'm not because
You're not.
I've traded and I lost money, so I'm just trying to then learn. It's okay. So what I did was I started trading without really learning the fundamentals. So this I put the horse before the cart, the
Mhm.
cart before the horse. So
Right.
now I'm trying to retrace my steps, learn, then
Awesome.
get better at it. Yeah.
Your story is, I'm sure it resonates with a lot of people where we all heard that there's money in the stock market, but nobody ever told us like how to go get it. So
Yeah.
we grew up around in the dark a little bit. We get some of it, we give back a lot of it. And
Yeah.
before we know it, we are we are lost and we decide, that's just for lazy guys who think they can
Yeah.
make money. But there is hope. There's actually a method to the madness. So we'll try and also decipher that.
Okay.
So thanks for bringing that up.
Thank you, Eddie. All right.
You're welcome. You're welcome. All right. Let's see. Anyone else who's joining us for the very first time over here? Let's see.
I am new. This is my first time.
Oh yeah, Michelle, this is your first time?
Yes.
I'm finding that hard to believe, but
We have never officially met, so I had a conversation. I've never been in the class. I came in from the study group in Canada. I'm in Canada.
Yes.
Yeah. So we've
Oh,
never
okay.
interacted. This morning is the first time we're actually interacting.
Welcome. Okay, then I was confusing your name with another Michelle Williams, who has the exact same name as yours. So welcome, Michelle from Canada. Pretty sure
That's what we need to make sure that we know, that this is the Michelle from Canada, not the Michelle you know.
Yes. That's so. Scratch my earlier statement that I was finding it hard to believe.
Okay.
So very cool. Welcome, Michelle. We have we do have a lot of students in Canada, and we also feel your pain because you guys are using interactive brokers.
We are.
Or something like that, or Quest. So we know that there are issues over there with the platform. But thanks for mentioning that you're from Canada. Welcome.
Thank
and
you.
I'm
So
assuming
much.
that you've done some options also. Is that right?
I have not done options.
Okay. You're in the right place. You're in the right
So
place. We'll fix that up for you.
Why, thank you. Thank you for having me.
You're welcome. All right. Real quick, anybody wants to introduce themselves and then we get on? Because I know that if we go around the block here, we're going to be here all day. Agnes is from Canada. She's new also.
Hi, Eddie.
Hey, how's it going, Agnes?
Good. How are you?
I am living the dream. Thanks for asking.
Mommy.
Okay.
Cool, Agnes. All right. It sounds like you also have a young company there that wants to learn how to do options, right?
I do. I do.
All right. Soon as they get that account rolling, we'll get them all squared out. Nice. All right. So let's talk about. I think I want to talk about the platform, and then I will talk about the fundamentals, all in the same breath. So the reason I'm doing that is because I realized that based on just the introductions, there are some people who've never traded options. Is that right? And then we have some people who have been trading options for a very long time, so which means they're familiar. So we'll try and cover both of those. This session is actually designed for people who've, all walks. You've traded options, not traded options. It's just an introduction to how I teach, get to know me, ask questions about how you can join the program and so on and so forth. So with that said, let me share my screen and see what we have. I'm going to share desktop number 1. I'm fairly certain that you all can see my desktop at this point. You're looking at my simulated trading, and it's divided into several sections over here. So got 2 watch lists. Actually, it looks like I've got 2 of the same thing. But let's go over this platform a little bit here. So if you're coming from stocks and you've been trading stocks and shares and not options, you know that the easiest way to do that, for instance, if you want to buy a share of Apple, all you have to do is know the price and know what to click. So there's several ways that you can do that. You can just click on the price and push buy, and that will set you on a path to buy stock. Notice here it says stock. Okay. And the price is 138. This is a limit order. If you wanted to do this with an OCO, by the way, stands for order cancels order, or one cancels the other, just depending on who you had it from. I don't know what the truth definition of OCO is, but it simply means that you have got 3 orders in one. All right, 3 orders in one. Essentially, you've got the first leg of the order, or the first order, which says that you're entering the trade. That's your opening order. The second one would be your take profit. Right, take profit, everybody understands that. And the third one would be your stop loss. You with me so far? So that's a 3 leg order. And why is it one cancels the other? It's because once you enter the trade, and let me go ahead and set this up as an OCO. So if I right click on if I click on Apple here and buy a custom with OCO bracket, notice that the system lets me buy 1 piece of stock or 1 share of stock at 138. It is going to attempt to sell it for me at 139 or whatever number that I put in. So I'm going to put in a arbitrary number here, 150, and I'm going to put a stop loss maybe of 135, right? Maybe I'm protecting myself with $3 down. How about that? But you can see that once you place this order, then these 2 now become dependent on each other. They're mutually exclusive. Only one of them can happen. You either take the profit or you take the loss, one of the 2. So that's just why it's called OCO. Now, on this session of on options with Eddie, we don't bother trading shares. In fact, once you know how to trade options, you will almost never go back to shares. I say almost never, because there are instances when we do want to buy shares, such as when we want to buy covered calls, or when we want to convert some of our options contracts into actual shares. Remember, 1 contract represents 100 shares. So there are use cases for that, but we rarely get into that. Most of the time we are doing options contracts. Now, I've shown you how to buy a share. How do we buy a contract for Apple? So with that, what we need to do is click on the trade, right? Click on the trade icon here, or word or label, I guess. And now you have an options chain. And this is where the fundamentals now come in. So we're looking at the options chain. These are expiration dates. And it's a contract. Contract means that this has an end date. One key difference between shares and options contract is that with shares, you can buy them and hold them forever. For example, if you buy 100 shares of Apple, we can hold them for 1 year, 2 years, 3 years, 10 years, 15 years, a really long time. We can gift them, right? They're transferable. If you choose to change your broker, say from TD Ameritrade to Thinkorswim or E-Trade or whatever, you can move with your shares. Did you know that? That answer is yes. You can move with your shares, but you can't move with contracts because they have an expiration date. They're special. So just keep that in mind about those key differences. If I expand one of these dates, and by the way, notice that there are some that say weeklies, others do not have the word weeklies. This just means that they repeat every week. That's all that means. It is synonymous with when you set a calendar item on your calendar and you make an appointment with someone, for example, your dentist. Maybe you meet with your dentist every 6 months, twice a year. Would that be a biannual maybe? Or would that be twice yearly? Something like that. Or if you meet with your dentist once a year or your optician once a year, then you would say yearly. So weekly just means every week. Don't make an appointment with your dentist every week, by the way. Yeah, that wouldn't work too well. Can't see your faces, so I don't know how that went. But anyway, so that's what that means. It just repeats on that schedule. Once we expand it, then notice I don't have as many columns as some people will have, but you might have a layout that has got many columns. Notice I've got delta, gamma, theta, vega, bid, ask, expiration, strike. Here's what I will do. I'll go over these real quick. And then you will understand why I only have just a few columns. So this is fundamentals of options trading. You can call it options 101. To start with, let's first understand, how do we make money using options? How do we make money using options? So if you buy something for $10 and you sell it for $15, it means that you can make $5. Is that right? Anybody think otherwise? That's how you make the money, yes?
Yes.
But you could also buy, I don't want to call it a bet, but you could buy a contract that says that I think the price of whatever I am selling or buying or trading, I think the value of that thing is going to increase in value. Okay, I think it's going to increase in value. So considering that, if I say buy a Ferrari and I am going to wager on it, right? I don't have enough money to buy the Ferrari, but I can buy a contract that says, I think this Ferrari is going to increase in value from say $50,000 to $60,000, right? That's my thesis. And so I'm going to buy a contract worth $1,000, and every time the value of that Ferrari increases, guess what? The value of my contract also increases, yes? That's how you make the money. So I don't actually own the Ferrari. I just own the contract that says the value of this contract is dependent on the value of the underlying. What is the underlying? In that case, it's the Ferrari. So coming back to stock, when we buy a contract of Apple, we're not buying a share of Apple. Instead, what we're doing is buying one contract that actually represents 100 shares. There has to be some underlying representation. So one contract represents 100 shares. It means that the price that you see here on the ask column or the bid column has to be multiplied by 100 if you're going to trade that. For instance, if I say that I bought one call contract of Apple for $1.96 premium, what I actually spent was $196. How do we get that? We simply multiply 1.96 by 100. That's how it works. So we'll get into a few examples here to understand exactly what we do and when we do it. So that's the fundamentals of a contract. One contract represents 100. Notice that we have several columns here. So let me start with the ones in the middle, the strike, right? The strike. So when you write a contract, you have to have some sort of basis. Okay, we understand that the price of the underlying at this moment is 137.87. And our contract can be based on a particular value. For instance, I can suggest or theorize that I'm going to buy the 136 strike. Why would I buy the 136 strike? Because it's already in the money, and we'll talk about moneyness. That's a real word, by the way, moneyness, because there's at the money, out of the money, and in the money. But real quick, these strikes go all the way from whenever they were traded, way back when, possibly even up to 1, and they go as high as whatever possible numbers that they can be traded. You can actually see what contracts are available by clicking on all, and that would give you all the contracts available to purchase strategies, and you can see there's a ton of them. But do we really want to do that? Probably not. So usually we want just a few contracts, slightly, or rather at the money, a little bit in the money and out of money. So in case you're taking any notes on this platform, this is the Think or Swim platform, and hopefully you can see the colors coming through the screen. And for me, this top part here is shaded purple. Okay, it's shaded purple. I don't know how it looks like on your screen, but on my screen, it is purple. And then on the other side as well, it's purple as well. Some of the things I want to point out is notice that on the right side of my screen, I have the word puts, and the left side is calls, and then the columns have been repeated the same on both sides. So which one do you do when? Right? Which one do you do when? So a fundamental fact here is that when you theorize that the price of the underlying might be increasing, right? When you think the price of the underlying is going to increase, then you're going to buy a call contract. It means that you're going to click on the ask column, always on the ask column on the side that says calls. You with me so far on that? So let's see what other thing. Let's see, maybe on what's these? This is a trade station, and I am looking at my sim. Looks like they have some new things. Web trading 1.4. Okay, that's cool. Take a look at that later on. So I'm going to look at my options chain for a symbol like say SPY, or you know what? Let's keep the theme of Apple. How about that? APL. Right. APL, and go to the options chain. I'm going to expand this so you can take a look and see what's happening. So once again, I have reduced the number of columns that I would normally that are normally displayed by default. I usually don't need them. I usually need just the bid and the ask, and we'll see how that works in the delta as well. So if you're looking at TradeStation, and I know a lot of you are looking at TradeStation as well, then this is the ask column that you would be clicking on if you are going to buy one contract of Apple. Notice the 136 contract is $3.20. The 139 contract is $1.45. And you might be wondering, why is there a price difference? Isn't the price of Apple the same, which is $138? Why are the prices of the contracts different? That's because the more risk depends on how much risk you want to take and how much profit you want to derive and how long you want to be in the trade. So we can do a few examples just to show if I bought the 138 strike for $1.96 versus if I bought the 134 contract for $4.90, what would be the performance difference between those two? Or what if I only had just a little bit of money and decided to go with the 143 contract and spent 30 cents? Remember, when you're spending 30 cents in premium, you're actually spending $30. You might think it's a good idea to go cheap, but no. And we'll figure that shortly. So let me go back here to Think or Swim and talk about these columns so that we can begin to dive right into trading. So we've talked about the strike. It is the basis upon which you're drawing the contract, and you have to choose one. And the best one to choose will usually be at the money or slightly in the money, regardless of whether you're doing a call contract or a put contract. Okay, remember, if you're buying a call, price is going up. So this is at the money, and slightly in the money would be up. Notice that the numbers or rather the strikes are reducing. So here's the rule. When you're buying a call contract with your thesis being that the price of the underlying is going to increase, you want to select a strike that is less than the current price, less than the current price. Okay, always less than the current price. Does it mean that you cannot buy one that is greater than the current price? You could, and maybe you have a strategy, but I don't know how that works. the best way would be to buy one that is less, and we'll see why. You will also be depending on some of these Greeks. That's what these are: delta, gamma, theta, vega. Those are called Greeks, and there's plenty of Greeks. There's rho. There's there are a few others that there's even beta, I believe. I forget all of them, but these are some of the more common ones that we're going to talk about. If you are buying a put, right? I'm switching gears here a little bit. If you're buying a put, it means that your thesis is that the price of the underlying here being Apple, is going to reduce. It's going to fall. So from 137 to 136 to 135 and so on and so forth. So notice that the purple shaded background here is also is what is considered in the money for puts. So the rule for puts is, if you're going to buy a put, the strike must be greater than the price of the underlying. That's how you make the money. We haven't put all the pieces together yet, but we'll get there in a second. So that was a strike. Notice that the date here is repeated the same. It's the one here, the 27th January. If I clicked on the 3rd February, that would be the same case. So let's stick with that. What's the bid and the ask? What's all that about? Well, the ask column is what you click on when you want to buy. Right? In fact, Thinkorswim has got this tooltip over here that says buy. I don't think they intended for me to see it. It's so tiny. Did anybody see that? Anybody ever notice that small caption? Yeah, they didn't want me to see it, so they made it small. And then there is the bid. If I wanted to sell, then it says sell, right? It says sell. What's this letter number over here that you can see? What's this letter that you can see on the B side? On this column, next to the ask column and next to the bid column. Anyone have an idea? Let's see whether anybody knows what this is. Pop quiz, right? So pop quiz. Let's see if anybody knows what that is. No? Somebody's sitting in the chat. Exchange. Dora says it's the exchange. That's right. All right. Gold stuff for you there, Dora. So the letter that you see to the right side of the either bid or the ask is where that data came from. Right? It's where that data came from. And we'll see. I'll make sure to click on the exchange so that you understand where that came from. Do we care about where that data came from? Not so much. Right? Not so much. Most of us are trading just regular stocks, regular securities that are in the mainstream. They're not over the counter or OTC. In fact, you want to avoid OTC stock. Little advanced topic over there, but you want to avoid OTC. So that's what that letter there is. The next column that I will talk about here is actually delta. I'm going to skip over these three and I'm going to go straight to delta and then I'll come back. So let's do this. I'm going to draw a line or a rectangle. How about that? I'm going to draw a rectangle over there so that you can see what I'm pointing to. And hopefully you can see a red rectangle there. That's my strike, the 138. Okay, that's the expiration date here, 27 January. It means that this contract is going to expire in 6 days. Okay. Now we also have a rule about the expiration date, about how far in advance that you should buy. It's called DTE, days to expiration. So we have some rules on that. So we've talked about the ask, we've talked about the bid. Let's talk about how these numbers change. Do they remain the same as the price of the underlying increases? What's the price of the underlying? It's this 137. And the underlying we're talking about is Apple. So as Apple's price moves from 137 to 138, 139, 140, and so on and so forth, do we think that the contract value is going to remain the same? And a few minutes ago, we just said, no, that number should actually increase. Well, how much does it increase is the question. Right? We bought it for 196 and many people struggle with, well, when do I know when to sell it? When do I know when to sell it? So there's plenty of formulas that you can use, but you need to understand the semantics of how does that number increase, because you want to buy low, sell high. That's the main thing. That's the whole purpose of trading is you want to buy something for a low price, sell it for a higher price, and the difference between those two prices is what you make. Less commissions, of course, but that's usually negligible. It's a small amount. So I buy a contract of Apple for $1.96 in premium, which translates to $196. And I want to make a few dollars. I want to make specifically, I want to make $100. How do I do that? So we can calculate relatively quickly how it's going to change by looking at the column called delta. So if you've been around anybody who speaks Latin or been around, I don't know, you did a math class, I think even in, doesn't have to be college, even before college, we've talked about delta. It's got that triangle sign, right? Delta is change. Yeah, delta means change. It's a Greek word that means the difference between two things. The definition of delta is the rate of change of premium. Right? Rate of change of premium. Let's break that down a little bit more. When we buy something and we click on the ask column, every time that Apple or the underlying increases, keyword is increases by $1. That's a rule. Every time that the price of the underlying increases by $1, then the premium is going to increase by the amount of delta. I said that real slow so that we can get it. So let's do an exercise. The price of Apple is 137 at this moment. Forget the decimal places. Let's assume that the price of Apple has now increased to 138. You bought the contract for 196. When the price of Apple is now 138, how much should that contract be worth?
Mommy, 2.46.
2.46. Tell me how you got 2.46.
So as Apple increased by $1, then the delta would change by 0.51. And
Okay,
since the premium is 1.96, I just added 0.51 to 1.96.
And you got
46.
You got 2.47. I think that's what
That
you
one,
got.
okay, yeah, 2.27.
Right, so she got 2.47, and her answer is correct, right? Real easy. So let's do that exercise one more time. The price of Apple is now 139. What is the value of my contract? Can I add another 0.51 to it? Everybody's shaking their head. They should be saying yes. The value is now $2.98. You see how that works? So assuming that, again, here in this example, let's say that we bought these for $1.96 and Apple increased in value by $1, then our new value is $2.47. If Apple increases by another $1, then it means that the value of that contract is now $2.98. So let's do some math here. If the value is now $2.98 and we originally bought it for $1.96, could we sell it at $2.98 and make the difference? That answer ought to be yes. And how much would we have made at that time? Simply $1.02, right? How did I get $1.02? $1.02 is 51 cents moving up twice, right? And is $1.02 all I'm making? That's in premium talk. So when I say $1.02, that's premium. In real money, that is $102. So folks, with $200, I just made $100. Now, is that cool or is that cool?
That's cool, Eddie. That's cool.
I'm thinking that's cool.
Oh,
In my book, that would qualify as cool. So let's see here if we can simulate that event here. Show on Windows. Let's see. How about if I do these? All right. Here's what I'm going to do. I'm going to minimize. I'm going to minimize this window here for a second here. And I'm going to go to on demand. I'm going to bring up Apple. On January 9, Apple was trading at approximately $132, right? About $132. And looks like it was rising. So that was about 10:16 a.m. Without doing a lot of math as to where I think it's going and not even respecting some of the rules, I'm going to demonstrate how we can make money on that. So let's see what we could have done on that particular date. My data is pre-buffering. That means I don't have a lot of data. Okay, there we go. So I'm going to buy the 132 strike, okay? And I'm going to spend $2 and change. So I'm simply going to click on that. The price now is $2.54. You know what? Let's just go ahead and buy that contract. How about that? Okay. This is a simple demonstration. So I just got filled at $2.50 something cents. $2.53. Okay. $2.53. So my thesis here is that Apple is going to increase in value. Well, I don't know that it's going to increase. That's just my thesis. There's a whole session on how do we theorize what direction or what kind of movement we're expecting. So here's my chart. Apple is still 132. Let me go here to the 15-minute just to see how it's behaving. And it looks like it's say the stack or something. It's not moving. Is it moving? Oh, maybe let's go to the 1 minute. Yeah, it is moving. It is moving very, very slowly. Very, very slowly. You can see that. I'm going to zoom in here. Looks like it's actually trending downwards. So remember that we bought a call contract. What was our thesis when we bought the call contract? Our thesis was that price was going to increase. Okay, you with me so far? That was what our thesis was, that price is going to increase. Well, what if price decreases, right? If price decreases or starts trending downwards like it's doing now, then do you think the value of my contract is going to increase or it's going to decrease?
It will decrease.
It will decrease. It means I'm losing money, yeah? And I have not lost it yet completely. It's called unrealized. Until I close the position, it is unrealized. When I close the position, that is when it becomes realized. Or in other words, you might have heard it said that you've crystallized your losses or crystallized your profit. We usually don't say crystallize your profits. We usually say crystallized your losses. Means that you've accepted the loss, you've closed the position, can't take it anymore, let things be. But when we talk about profits, we say locking in profits. Right? So one's positive, one's negative. Okay. How would I know how much money I am making so far? Well, on the platform, if I go to the monitor tab, oh man, these guys they probably had a meeting or two just to come up with that name, monitor. Yeah, monitor means exactly that. You're monitoring your price. So just remember your trade. So you can see that under the equities and equity options section, I've got my instrument here, which is Apple. If I had traded more than one thing, it would all be listed here. And then I've got several columns, right? I've got the quantity here. So I'm going to expand that. All I did was click on that small caret to the left of the word Apple, AAPL. Let's break it down. My quantity at the moment is +1. That means I bought one, right? Pretty simple with that. If I had sold it, it would say -1. The ITM that you see here next to it says that means that it's in the money, right? It's in the money, meaning that 132 is below the current price. Okay, the 132 strike is below the current price. If that price goes above 132, it will still be in the money. If the price drops to below 132, it will be out of the money. Okay. 4 refers to the number of days to expiration for this contract. Pretty simple, right? Trade price refers to the price that I paid for that contract. The mark is the last traded price for that particular contract. So you notice that they interchangeably use the word last. They also use the word mark. Then you might hear me say the options premium. All of those mean the same thing. So right now it is at $2.56. Means that our thesis is working in our favor. The change, the mark change here is $1.14. Let's understand what this means here. It means that from the time that this session started, that session refers to 1 day, the price has increased by $1.14. Right? The price of what? The price of this particular contract has changed by $1.14. Means that it shot up this morning. That's what that means. Notice the difference between the mark and the trade price is your current P&L, profit or loss. So if we were to freeze it at this particular moment, then it means that we have lost so far 253 minus 252, 2.525. We've lost about 50 cents so far, right? That makes sense? So right now we have not made any money yet. Neither have we lost any money worth talking about. We're basically flat. That's how you read these equity and equity options section. I'm spending a lot of time here because this is a frequently asked questions. Even before we decided, let's talk about the platform, this is one area where people want to know. And with good reason, because when you're trading, you need to know, are you making money or not? And this is where you know that you're either making it or not. So in this particular case, we are losing about $4. How are we losing $4? Well, we bought it at 253 and the current price now is, well, just jumped up, right? It was 249, the difference was $4. So this is a very, very important section to think about. You know what, let's choose something that actually moves a little bit more so we can see how that works. Anybody ever traded S&P 500? You guys all, you're probably not. Dora, I know you've never traded SPX.
Right.
Yeah. They just came up with this one last week, so not many people know about it just yet. So let's theorize here that SPX is going to trend downwards, right? And we're going to do a put example. Put means that we expect price to trend downwards. And so we're going to buy a put contract. This is the opposite of a call contract, right? Remember when we theorized that the price of the underlying is going to increase, we decided to go with a call contract. But when we think the price of the underlying is going to reduce, we buy a put. Yes. So let's see whether we are right on this one. And let's first interrogate these.
You're looking at the 1 minute.
I'm looking at the 1 minute. Yeah. So I probably should be looking at the 15 minute. Okay. So the 15 minute, and this could either go downwards or it could go upwards. Does anybody have an opinion about which direction it could go? Or how do we even know what direction it would go?
I'm thinking if the market is up, then I will probably look at the 1 day and then trade from there versus the 15 minute. And
versus the 15.
Yeah, I wouldn't buy put because the market is going up.
And she would be right. So what she just described is that you make your decisions on the daily time frame, not on a micro time frame. It's important that before you trade, you plot your chart, right? You plot your chart and decide where do we think price is going to go, and use that decision to help guide our next move. Okay. So Joe just said that based on the current trend, based on the daily chart, she believes that price is on the uptrend. We can see that, in fact, that might, let me see. This is the daily candle here. It's already green. We are trending upwards. And based on that information, we are probably going up to this gap area here. But that's a deeper subject there that we can talk about. But let's go back here to the 15. I want to see how this trend line is forming. It looks like we're pulling back just a little bit, and I want to show this example of a put. How do we do a put contract? Okay. So once again, I'm going to go over to the trade tab. This is where we always start, the trade, and I'm going to select maybe 1 DTE. How about that? January 10. Oh, you know what? Let's go with let's go with January 10, which is 1 DTE. Maybe it's my internet that's really, really, really bad, or my data is bad. It's probably my data, huh? Or both.
Yeah, they're doing updates.
Yeah. So on the top left on my screen, it says it was saying pre-buffering. Okay, there we go. Finally. Okay. So let's take a quick peek at our thesis one more time. We're still on a downtrend. We want to demonstrate buying a put. So I am going to click on the first strike that is at the money or in the money. Remember, when you're buying a put, the value of the strike must be greater than. So anything greater than 39.27 is already in the money. So if the 39.30 is a good candidate, and I'm just simply going to buy that just for demonstration. Looks like I got filled at 21.70. Okay, 21.70. The reason I did that is so that I can go back here to my monitor tab, and we can look at the different things that are happening. So, because this can get very confusing. It can get very confusing. All these numbers, no pictures. Man, these guys should have thrown in a few pictures. But did they ask me about it? Nah. Are they going to ask me? No. They're probably not listening, are they? But if they are, some pictures would have been nice. The visuals I think are very important. So let's talk about this section. Working orders means that if you place an order, then this is where it would appear before it has been filled, right? Think of it as you're driving through the drive-thru on Starbucks, and you're at the microphone over there, and you've ordered your Starbucks, and you're still waiting in line to get to the window to pay, or maybe you paid already. Then your order is working, right? Makes sense? It's as simple as that. It's no more complicated. Filled orders, when they finally hand you your Starbucks coffee, now your order has been filled, right? That's what it means. If you cancel the order before you get to the window, or even when you get to the window and you cancel it, this is where it would appear. Right? So that's all that means. And we're back to the equities and equity options. So notice our Apple contract is actually doing well for us, right? Because it's got this PL open, right? Profit and loss open, $24.50, right? $24.50. And our SPX is losing $95 so far. Let me expand this so that you can see. We bought the contract at 21.70, and it is now trading at 21.20. So, so that means that it's on a losing trend, right? By how much? About 50 cents, which translates to about $50. So you can see the monitor tab here does help us understand what's happening to our positions. The sum of the PL open for everything, both the positive and the negatives, that is our net. So you notice that positive 28 and negative 130 at this point comes to negative 100, give or take. So that's how you determine. So this is a good opportunity to understand how do we close this order. Since we entered this order without a bracket, I'm going to show you two ways to do it. I'm going to show you two ways to close your positions when you entered the order without a bracket, meaning that you did not have a take profit and you did not have a stop loss, or maybe you just had one of them and you want to figure some things out. So right now, I'm not going to worry about the Apple. It seems like it's making the $30 give or take. So that's cool. I'm going to leave that one alone. But the SPX, it looks like I'm down $145. Not good. No bueno, right? So let's go back to the chart and see. What if I put a stop loss and say that, I think that if this thing continues to lose, I will cut the trade. But if it turns around and starts going, if it turns around, then I want to take profit. So what I would do is, from my monitor tab, what I would need to do is right click on the symbol itself, right? So right click on the symbol itself anywhere on that line, and I'm going to create a closing order. I'm going to do two things with this closing order. I need to know there's some information I need to know first. How much did I spend? That answer is $21.70. It's sitting right there in front of me so I can see it. I want to create a closing order by selling. I'm just simply going to click on this. Okay. So I clicked on that. Let me reduce the clutter here. And now I've got my sell order, but it's got the price. It's got the current price, but this is not the price that I want to sell it for. Instead, what I want to do is create a bracket for a position that is already open. Okay, a position that is already open. How do I do that? Well, first, you notice that it says advanced single order right here. I'm going to change that to OCO. Once I do that, then I'm going to duplicate this particular order and then make some changes on it. So I've created a duplicate order by simply selecting create duplicate order. And I'm going to create, I'm going to specify that I want to take profit. I want to sell it if the value reaches, let's say $25. How about that? Right? If the value of my contract reaches $25, then I will take profit at that particular moment. And if the value reduces instead to say $15, right? Is that a reasonable stop loss? Maybe not. Let's go with $16. Then I will get a stop. You see how I did that? I created, oh, this I thought it was 25. I wanted 25. Yep. So I want to sell this contract at $25, meaning that I will take profit at that much. And if it drops in value all the way to $16, please take me out. That's what I'm telling this system to do. And so I changed this from limit to stop. Now, if I send this order, confirm and send, I'm simply adding two orders to this. And let's see where that went. Let's go back here to the monitor tab and look, this is a mutually exclusive order, meaning that only one of them is going to happen, right? It's either going to take me out with a profit or it's going to take me out with a stop. Make sense? And I can also see the mark here is giving me information about how close am I to these, or how close am I to getting stopped out. I'm about $1.55 to getting stopped out, right? About $1.55 to getting stopped out. Go ahead.
Hey, Eddie, what
Yeah.
about your GTE?
My
DTC.
DTC by you mean good deal canceled?
Right.
Yeah, I could change that. Good deal. Meaning that the timing force is what she's talking about, because this contract is what day is this contract? This is a 2 DTE contract or 1 DTE contract. So it means that if none of these events have happened by the end of day today, will this still be there tomorrow? The answer is no. Right? The answer is no. It needs to be GTC or good deal canceled. We know that GTC goes to 90 days, right? 90 days. So how do we make those changes? We simply right click on that, do a cancel replace. This is probably going to fail because all orders must have the same time in force. Let's see whether this is going to work. And well, let me do it. So we change that to GTC. Let's also go and change the market here to GTC. And that was a good point on that. I think that was Faye's voice. I think I can recognize that voice. Right. GTC, time in force. That's what that TIF means, time in force. Very simple, isn't it?
That was me, Eddie, but you enforced in our heads. When we make these brackets, we have to do the GTC. You did that.
That's right. That's right, Faye. I stand corrected. Thank you. So yeah, for those who are not familiar with GTC, that simply means good till canceled. Means that when you put in the order and it does not get filled today, for example, your take profit does not happen today, it means that tomorrow morning or the next business day, that order will still be in the system. But if you leave it like I had left it here with day, D-A-Y, for the time in force, it means that that order is going to be dropped from the system at the end of day, right? End of day. So real quick, if anybody's watching my screen, who thinks that I'm going to be stopped out? Anybody think I'm going to be stopped out?
Yeah, it's looking like it.
Looks like I'm going to be stopped out, right?
Mhm.
Yeah, because my stop loss is at 16 and my stop loss, the price, the current price is $16.30. Okay, so a bracket order is very, very important because it helps protect you automatically. It means that at 16, I won't be trying to make the decision, should I stay or should I go? Sounds like a song. That's probably a country song with that. Should I stay or should I go? Okay. Yeah, if you're into music, maybe you should write that. All right,
Stay.
Yeah,
We stay, we're not going.
Yeah, we're not going. Okay.
No.
You know, country songs, it's got to have something about love. It's going to have something about somebody going away. It's going to have, you know, all those components. So we are now at 16.2, and we're going to see how this works. We're just going to let it do its thing, right? And we're demonstrating a put. We added a bracket order to it. We're this close. We're about 20 cents away from getting stopped out. Now, could I, you know, proactively decide that, you know what, I don't want to lose that extra $20. Could I go in and just change my stop or change my order? Oh, there we go. We just got sold at 15.35. I want you to note something. Our stop loss was at 16. We got sold, or we got filled at 15.35. Why didn't it sell at 16?
Stop losses are not guaranteed, and look at the chart. It's probably a quick move down.
Absolutely. Let's take a look. Let's take a look at the chart. Looks like there was a gap upwards, or not a gap upwards, but a strong movement upwards, and it immediately took you out. So you can see how a stop loss prevents you from losing a ton of money by taking you out at the closest. Now, unfortunately, you don't have too much control on the price of the end of the contract when you do a stop loss with the market order. But there is a way that you can control that price. It also comes with risk.
Eddie, that's what I was going to say, that your stop was a market order.
Yes.
And that's probably why you got stopped out.
Absolutely. Yes. So that's why we got stopped out. But let's demonstrate how can we create a stop or a stop loss and not have it be a stop order, right? I mean, a market order. How about that? Can we do that? Jacqueline, what do you think? That'll be the next best thing since sliced bread, right?
Go for it. Go
Yes,
for it.
I believe you can do it. I believe you can fly. Go ahead.
I believe you can fly. You know, if I didn't know any better, I think you sing like George Bush. Oh, wait, he doesn't sing. Yeah, let's do it. Let's do it, Jacqueline. So we still have one trade in play. Let's go back to our monitor tab here and see that we are up $34. Right, we are up $34. Our PL open is 34. Our PL open on SPX is now 0. It means nothing. When you see 0, it means that you don't have a position open. In fact, if you expand this line here, you will notice that your quantity has reduced. It was +1, now it is 0. Well, how do we know how much we lost today? Well, this doesn't tell us. Can we ask it? I think we can. So I am going to click on, let me repeat what I just did here. I'm going to click on this cog wheel here, this cog icon, and I'm going to add a column to this display so that it can tell me my PL for today. So I'm simply going to click on that. I'm going to click on my lookup column, and then I'm just going to type in, start typing P/L. Looks like I now have PL day. So I'm going to add that to my columns so that I can have a better view. So we just added PL day. So even if my position is closed, I can see that we lost $635 on one contract. At the beginning of this session, we said that you can make a lot of money. You can also lose a lot of money. In this particular case, we just demonstrated that we can lose $635 in a matter of minutes. No bueno, right? But we also saw that we can protect ourselves by adding a stop loss. Okay, so let's demonstrate a different way of adding a stop loss, but this time controlling whether it's going to be a market order or not. So let's do it. I'm going to, again, note how much I paid for this Apple contract. It looks like it's at, I paid $2.53, and it is currently trading for $2.83. What if we propose to take profit at, say, $3 and propose that we stop ourselves out? I'm going to go over here to Apple. Where is Apple? I'm going to go to the chat and say that if the price reaches 132, we should exit this trade. If the price reaches 132, we should exit this trade. Okay, let's do that. So I'm going to go back here to my monitor tab. I'm going to right click, just I did like last time. I'm going to click create closing order. Go ahead and sell that. I'm going to create an advanced order here of OCO type OCO. I'm going to right click on this sell order and I'm going to duplicate it. You know what? Let me go ahead and change this to GTC so that it's already, when I duplicate it, it's the right thing. So I'm going to create duplicate order. Notice that it carried my settings. And I want to sell one contract of Apple once the price reaches, you know, well, let's go $3.20. How about that? Give it a little bit of room. Okay, $3.20. And I want to create a stop. But if I just create a stop, this is going to be a market order, right? This is going to be a market order. So I don't want to create a stop order of the type market order. Instead, what I want to do is create a stop loss based on the price of the underlying. How do we do that? That's $1 million question. Let's try to do that. So when I mouse over this line here that I want to manipulate to make it a stop loss, notice at the very end, there is an icon here, the cogwheel, the famous cogwheel. It's all over the place. We're going to click one time on that. And now we've got this really complicated screen here, right? But it's not complicated. Let's break it down. It simply gives us the ability to add conditions to our order. Let's see how we can do that. Where it says conditions, that's what we're going to do. Right under the word conditions. Can I do this in on demand?
No, you can't.
You may
It's not
be
available.
able to do that with on demand. You can do conditions on demand.
Yeah.
Yikes.
You can do it in SIM, but not in on demand.
Yeah. Oh, man. Missed opportunity over there, think or swim. If you're listening, and I know you're listening to my Zoom calls, missed opportunity, big missed opportunity there.
Hey, Eddie, why don't you just try to set it up? I mean, you won't be able to launch it, but just set it up for semantics to see how it goes.
Yeah, I need to click on some things over here that are not available.
But just walk us through it. Maybe if we watch the video every time, we can try to apply it.
I tell you what.
Were you able to click in that box when you pulled it up? Were you able to click on the box? No. Okay.
Nope.
Then no, you won't do it.
Yep. So let's figure out another way. I am going to go to my I'm going to go to my SIM trading here. So notice that I've got both my on-demand and my SIM open at the same time, and that's because I can. How about that? I can open on-demand and open my SIM all at the same time. And let's go ahead and get into an Apple trade. What date was that we had picked? Was that January 27? And I think that was the 138 strike. So let's go ahead and do a buy. Tell you what, I'll do a fast triggers OCO. How about that? Or I'll do a bracket order, right? That's what I want to do. I want to do a bracket order with OCO, and I'm going to manipulate it like that. So we say that we want to take profit at $3.20. Okay. And this next line item, instead of creating a stop order of type market, we're going to maintain limit. But this time we're going to manipulate that limit order and say that, yeah, this is what I'm looking for. So this is the screen that I need to see. When I click on that configuration item for that line, I want to see this conditions section. And right below where it says symbol, I'm going to click one time on it. By default, it goes with whatever symbol that we're looking at. The method here is going to be mark. You've got plenty of things here that you can choose, but you want mark. Means that I want this condition to trigger when the mark is something. What is that something? Less than or equal to a particular number. So I'm going to delete, I'll leave this line, do I? Let's see, maybe I click too much. Okay, yep. So when the threshold of that mark reaches a particular point, and we say that we want the price to be 132, what's going to happen? We're going to submit this order when the mark for Apple is less than or equal to 132. But wait, there's more. Now I need to adjust the top section over here. I am going to sell. It is going to be a limit. I'm going to change this offset here to 0, meaning that I want these to be at the median. The time in force, I'm going to select here to GTC. That's cool. But the price rules, I'm going to change from limit to mark. So right now it says limit. I'm going to see whether I can scroll down here. I'll start typing market, mark, where's mark? Can I not do it in
market?
In SIM as well? Is it? No, it's
market,
not market.
Market is marked.
No, it's not. It's the price rule here needs to be mark, M-A-R-K. No, not MLC. Lo and behold, you cannot do these on SIM as well. This needs to be mark, M-A-R-K. You've done this example before, right? So this should be, I'm 100% sure this, you know what? Let's go back to, let's go to live. How about that? Is that cool? Let's do a live trade. So I am going to leave my SIM trading and go to live. How do I go to live? I'm going to switch from on demand to live. And let me stop sharing here for a second, hide a few things. Sim on demand. I'm going to set it up here. Custom with OCO. And I'm going to change this time and force to GTC. Just give me a second, guys. I'm going to start sharing my screen here in a second. Okay, I think the price rules are limit. I just tested it out in live, and it appears that that was in fact correct. So let me go back here to my example of the sim, which means that I can start sharing it again. Right? Trade. And where's my share? I'll share something. Right. You all see my screen, yeah? Okay, so this is supposed to be stop, and we want to change these from market order. We want to change that to the mark, less than or equal to 132. And the price rules are limit. And the offset here is 0. Time in force, we can change that to GTC. All right. So if you're looking here at my screen, you're setting up a rule based on the price of the underlying. And what we did was click on that configuration link or icon. We changed the conditions to where when the mark is greater, less than or equal to 132, go ahead and trigger a sell, and the price rules are limit. What is the price that is going to be at that point is going to be the mean of the bid and the ask. So you have a very, very controlled stop loss. And that is usually a little bit safer when you want to control your exit. You can see that this is kind of complicated. By the time you set this up, that trade may or may not, still be there. And then of course you click on save, and notice that now it says that the link here should be marked. And then you can confirm and send. So let's see, why does it not say mark? I know why. Because all these times in force must be the same. So let's see when this is going to be activated. We're going to change that to GTC and GTC. Look at that. So when you have 3 orders, or when you have a bracket order, the time in force must be the same. So even though you see here that the price is 0, well, we've already configured what the rules should be to get our stop loss. And also notice that it no longer says stop, it actually says limit. Okay, so watch this section a few more times just so that you can understand how this works. And I'm going to push confirm and send. Obviously, the market is closed. It's not going to go anywhere. But I'm going to look at my monitor tab, and I have created a bracket order. So you can see that the first leg is to enter the trade. The second one is to take profit. And the third leg is to stop us out. Okay, right now it says base minus 1.96. That's not true. It is simply going to be based on the rules that we set. Okay. Questions on that? Those are complicated things for people who have not done any options trading yet. So I don't expect that, you're going to pick it up right up, get up and go and implement it. The easiest way still is to simply do a bracket order that's got your order entry, your take profit, and a regular stop loss. At the very minimum, that's what you should do. Okay, guys. Let's see what else I haven't covered. Cool. Jackie, what do you think? Actually, I see a new face.
We good. We are good.
Okay, that was actually a question for Jackie Harris. I know you're Jacqueline.
Oh, that's right, not Jacqueline. Yes, I'm sorry, Jackie. I took your question. I'm sorry.
But Jacqueline, how things going? Yeah, what do you think?
I think this is perfect. I'm looking at you. I'm doing this. I've never done that.
Yep.
The second part that you just did. I'm like, okay, that's interesting. I've seen people do it before. But I was like, that's just too much stuff to do. Now I understand it a little bit better the way that you explained it. And I thank you for that.
You're welcome. You're welcome. So I have done it a few times. And like I said, this is a slow way to do business. But if you are doing a swing trade, you've got plenty of time to do this.
Yeah.
If you're doing a day trade, you're trying to get in and out, then unless you have a lot of time to set it up, or you have a template, because you can set up some templates for this, then it's not exactly an easy task to do on the fly.
Right.
Awesome.
Too many other pieces to it.
There are a lot of moving pieces, and you can see, we had trouble even simulating it on the on-demand. And that's one of the shortcomings of on-demand. It's a really good platform for learning stuff and strategies, but some of the finer pieces of on-demand and or thinkorswim are not necessarily available with the on-demand version.
Okay. Hey Eddie, question.
Yes. Yeah.
I really like this review of being able to do that. You had covered this with us way back when, but this is an excellent review. With SPX, because it moves so quickly, how would this work setting up, that stop with SPX because it moves so quickly?
Okay, good point. So with SPX, because it does move quickly, I do agree with that. I generally don't do the stop losses there based on the price of the underlying. Instead, I just do a simple bracket order, right? So for instance, I might, so let's go with the 2DTE here, and we're going to spend a little bit of money. We're going to spend $1,600. How about that? So what I would normally do is, and I've got several templates that I've set up, and I would, well, let me show you how to set up a template. So I'd begin by going with the default OCO bracket, okay? And Faye, how much money do you normally like to pick up when you trade SPX or anything like that moves that fast? $200?
I'm looking for at least 500 plus.
At least 500 plus, right? So even without doing any sort of math, could I simply come over here and do $16.70 plus $500? Or plus 5?
Right.
You could do that, right? But what if the price changes? The price of the underlying, the price of the contract, then you have to recalculate it, yes?
Right.
Well, that's a lot of work. You could change these by simply breaking this chain link here. Notice if you're following my cursor, see there's this little icon over here?
Right.
I'm going to break that. And now it says trigger under the link, and I see a plus or minus and a +1. Now, you just told me that you like to make $500. Guess what? I'm going to put here +5.
Right.
What is $5 in premium in real money?
500.
$5, $500, right?
Right.
Next thing I'm going to do is I'm going to unlock this padlock. I'm going to tell the system that I'm not stuck on one price. In fact, give me the best price that you can. So I'm going to unlock this padlock so that when I push confirm and send, it is going to get me this price or better. If I keep it locked, it is only going to give me this price and no other price. That's the big difference between this padlock being locked or unlocked. So I want it unlocked so that I can get a better price than that. And whatever price that it gets me, I want it to give me profit at $5 increase.
Gotcha.
In the same breath, I also want to change my stop loss from a fixed number. And this time I want to set a trigger on it and say minus something. So Faye, how much do you normally risk on your contracts on SPX?
I don't want to lose any more than $200.
How much?
200.
$200. So what number should I put here? 2.00. You're right. That's very conservative, though.
I know.
That's very conservative.
Especially on SPX.
Especially on SPX, but it's not bad. It's better than nothing, right?
Well, I'll
it's better
go
than
250.
nothing.
I'll go 250, half the profit.
I like 250. At 250, you better know whether you're wrong or not, yeah? All right, two and a half. So 2.5 is good. Now remember, if you go up in contracts, it means that 250 now becomes what, 500, right?
500, yeah.
Do you not? Do you normally do one contract, several contracts?
Two.
Sometimes two. Okay,
Just two.
So I could push the plus sign here up like this. You know what? That's an easy way. How about I just link all of these and increase that by 2? Do you see that, Faye?
I saw that. See there?
You hung around me, you learn a few things.
Yeah.
Oh boy. Yeah, so we want 2 contracts. It means that we're now risking $500. That's $2.50 per contract. And because this is also GT's, the 2 days to expiration, guess what? I'm going to link these up. So I only have to change it in one place, GDC all the way through.
Wow.
So learn these shortcuts because, what's that?
Can you do that one more time?
Simply linked or unlinked by toggling on and off the chain link. So when I see this right now, the chain link is broken for this column, means that they're not all tied together. So I have to change them one at a time, right? That's the slow way. That's really slow. If I wanted to change all of them at the same time, simply link them together by clicking on the chain link to close it, and then you change the top one, and notice that it changes all of them at the same time. So you can do the same thing for that column and also for the quantity column. So I've seen people do plus, 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 and then plus, 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 plus. You know, by the time you finish doing all of that, you know, you've got some gray hairs. And if you have some gray hairs, you now have no hair.
That's great. That's great. I learned something today. I really learned something.
Awesome. So there's your bracket order. So we are saying that we are leaving the padlock unlocked. We are taking profit at $5 and we are risking $2.50 per contract, and we're buying 2 contracts. Now, do we have to do this every single time? How about we just save this as a template and we can reuse it anytime, whether it's a call or a put? Well, there's this icon over here that looks like a floppy disk. It looks like a floppy disk. So not a whole lot of people know what that is.
I know what it is, Eddie.
Faye knows what it is, but I'm suspecting that Mary does not know what that is.
Flash drive, thumb drive.
Floppy disk, right? 3.5 inch. Oh boy. So if you don't know, you've got an assignment to go find out what is a floppy disk. It means that you want to save something to a disk, right? So I'm going to push on that. And notice, yes, exactly. I know I shouldn't be talking about this, right?
Right.
So I'm going to give it a name here. And since Faye came up with this one, I'm just going to simply call it the Faye. How about that?
You
And
put
the
it on
Faye-
me, Eddie?
Well, I know, yeah, you've got to, +5, and she risks 2.5. How about that? Right? Sure there's a dollar sign in there. So +5, risk $2.05. Right? You know what? I'm also going to say here 2 contracts. 2 contracts. Just so that we understand or identify quickly. So Faye, here's how you use this, right? So I'm going to delete this order. And let's assume that, okay, well, we think that SPX is now going to go down. So how do we do that? We simply go to the options chain, pick the fast strike in the money. We're going to right click on the ask, buy custom. We're going to choose the Faye. How about that?
Oh, okay.
Bada bing, bada boom. Boom.
Got it.
Is that cool or is that cool?
That's cool, Eddie.
Can we use it on any other symbol? Well, let's find out. Let's go to Apple. Let's go to Meta. All right, let's go to Meta. And hello, data. Hello, data. Data, come on. Yeah, there we go. Finally. All right. Well, almost. Okay, so we want to see whether that template can be used on any other symbol. That is the question. So we're simply going to right click on the ask column, buy custom. We're going to choose the Faye. And yes, it does in fact work. Calls 139, 2 contracts. Take the closest price or better, add 5, risk 2.5. Now you notice that Meta doesn't move that much. So would this be a tall order? I think this would be a really tall order.
Tall, yeah. Mm-hmm.
Yeah, very, very tall order. So do you want to adjust your template and save several templates? That answer should be yes. Right? So you should have one template maybe for SPX and another template for stocks that move $5 to $10, and another one that moves a crazy amount of dollars, any type of situation. So you can have many templates. So there you go. There you have it. How are we doing on time? Almost 2 hours. Oh yeah, I think this is a nice stopping point. Any questions that you want to feel that maybe I should look at? So we've gone over some fundamentals. Let me finish that thought process I had on the chain here, the options chain. We said that we're going to talk about delta and then come back and talk about these other Greeks. So let's talk about them. We identified that delta affects the premium. So we know that delta has got this one meaning that says it is the rate of change of premium. For every $1 increase, then the premium is going to increase by the amount of delta. The same is true if the price of the underlying reduces, right? So if it goes from 139 to 138 and so on and so forth, it means that these 305 will be adjusted negatively by 0.53. You will have lost 0.53 cents of that premium, which translates to $53. Now, remember that is unrealized until you close that position. Okay, until you crystallize that with a loss or lock in your profit. Well, does delta remain the same? No, delta does not remain the same. Now, delta goes from 0 to 1, or you could say 0 to 100, depending on what function you're referring to. So another function of delta is the probability in the money at expiration. That's what that means. So at the money, you have a 50-50 chance. You have a 50-50 chance of expiring in the money. You don't know just yet. But as you go deeper in the money, your probability of that contract or that strike expiring in the money increases all the way to 1 or 100%. And by the way, when I say delta 50, delta 60, I'm actually referring to 0.5, 0.6, and so on and so forth. So with a delta 80, I have an 80% chance that the 133 strike is going to end in the money, which is a great thing. That's a good thing. Now, when you have such a surety of success, it means that the contract value is also high. So you notice that the higher the delta, the more expensive the premium. So with a delta 80, I'm going to end up paying $7.40 or $740 for the 133 strike. Right? Now, why would anybody do that? There's several reasons why one could do that. I don't know whether we have enough time to talk about that. But essentially, that number is important at expiration. At expiration, if the price of the underlying is greater than the strike, then that contract still has value. A key point to know is that if you do not sell it, for example, if we buy the 133 strike for $740 and the price of the underlying, or rather the contract expires 6 days from now and we don't sell it, do we get to keep that, or do we lose anything on what happens at $740? Let me see if anybody knows. What happens at $740? Do we lose it or do we get it back?
You get it back.
You get it back?
Yeah, because
No.
it's expiring the money, right?
If it expires in the money, the premium contract, or how much you paid for it, you lose it if you don't sell it. So that $740 is lost. It's gone.
Wow.
Right? In order for you to make anything out of it, you have to sell it. If you don't sell it, you lose that $740. But the question still remains, does that contract have any value? And the answer is yes. Well, how much value does it have? It's 133 minus, or the difference between 133 and the price at which it closed. So if the contract closed at 139.37, then the difference between those two numbers is 9.37 minus 3, that would be 637. So your contract would be worth $637. You with me so far on that, Adjua?
Mm-hmm.
Right? So if you don't sell it, you lose the premium that you paid for it. But if it expires in the money, then your account will be credited that intrinsic value. Right? So that's the intrinsic value of a contract.
Mm-hmm.
What if you had bought the 145 strike and it expires out of the money, meaning that the price was 139 and the strike was 145? First and foremost, you lose that $88. Does the contract have any value? The answer is no, it's out of the money. Right, out of the money. So let's talk about gamma. So delta changes every time the price of the underlying changes. Gamma is the rate of change of delta. So delta will increase by 0.06 cents every time the price of the underlying increases by $1. You can see the relationship now between delta and gamma and premium. Well, is gamma constant? The answer is no. Gamma is influenced by the Greek called vega. Vega is a volatility index that determines how much gamma is going to increase every time the price of the underlying increases. So you can see there's that change. Do we need to go, so deep as to figure out what changes, what affects what, and all that? Answer is no. You only need to think about delta because that's the second to the last critical point that you need to know. So if you have think or swim, what you need to do is now change your layout and remove and push customize and remove all this other noise that is not making sense at this time. Oh, we haven't talked about theta. Theta is time-based. So a lot of people know about theta. So now you understand why my look and feel has only got the delta, the bid, the ask, and the strike, and the expiration date. You cannot remove bid and ask. Okay, you cannot remove any of those. Can you hear the fireworks in my background?
No.
You can't
Loud
hear
and
them?
clear.
Oh, loud and clear? Yes. You got fireworks going on. I think there's some festivities happening in my city right now. So, all right, cool.
Hey, Eddie, quick question.
Mhm.
To finish out your example about not selling the 133 strike and getting the intrinsic value,
Yes.
if you sold the, of course, you always encourage us to sell. Don't let it expire. Sell. That's locked in my head. You etched it in my brain.
Yes.
The seven you sold it. Let's just say you sold that. And it's 740 was your premium. Of course, you gonna sell it, for more. You would get your profit, but you wouldn't get the intrinsic, or you combining them.
So if you sell it at that time, if the price is 139 and the price has been increasing, it means that more than likely your premium has also increased.
Right.
So the likelihood that we'll sell it for greater than 740 is very, very high.
Okay.
Okay. So remember, the way that we calculate profit is how much did you spend on this thing that you bought?
Right.
Right, 740. How much did you sell it for? Let's say we sold it for $10. Then the difference between $10 and 740 would be your profit.
Gotcha.
Another way to look at it real simply is you come to Eddie's bank and you borrow $7.40, right? And you go buy a contract for Apple. It increases in value to $10. And once you sell it, then you come back to Eddie's bank and pay him $7.40. Does that make sense? A lot of people have trouble understanding where does that 740 go? And the answer is assume that you're just borrowing that money and you're then selling it. Give me one quick second. Let me close the window here, right? Okay. All right, thank you. Yeah, that was a lot of fireworks. I mean, I guess people are happy, I guess. So Faye, you got that the 740 and the $10 example, right? Am I still on mute?
Yeah, gotcha, Eddie. I keep the difference. Okay. I gotcha.
Got it. All right. So and there's also a column that you can add to your options chain to give you an idea. So let me go ahead and customize these again. I'm going to add two columns here. One is called extrinsic value, and another one is called intrinsic. Let's explain that. Theory on that. So I'm adding to that, and I want you to see the difference between the extrinsic and the intrinsic value. First and foremost, everything that is out of the money has got zero intrinsic value. It means that it has nothing. If it expired today, right now, this minute, it has no value.
Gotcha.
Okay. But intrinsic value is what that contract premium already has. Remember, the price of the premium or the value of the premium has got several components. One of them happens to be intrinsic value. The other one happens to be time value. The time value component decreases over time. The intrinsic value holds its value for as long as that contract is less than the current price. Okay. So you notice that the higher the deeper the strike, or the deeper the in the money, the higher the intrinsic value. For extrinsic, for out of the money contracts, you have no value. Okay, but you do have extrinsic value. When we talk about time decay, right? When we talk about time decay, extrinsic value is the one that goes down to zero. It must go down to zero. You with me on that? Must go down to zero.
Gotcha.
So intrinsic value does not decay. Extrinsic value is the one that decays. Big difference. Okay. So all of that is this is not information that I rely on to determine whether to get into a trade or not, or whether or which contract to choose. I have other criteria that I choose to help me decide which contract or which strike I am going to choose. Okay. So let me go ahead and customize this again, remove intrinsic and extrinsic. And these are the only ones that I need. It's getting loud over here, so I'm going to end this call a little bit early. How about that?
Can you go over the spread, getting out of the spread, please?
I need to set up an example on that one. And because you talked about a debit spread, which is something that I teach inside my class, I may have to get with you separately on that. So
Okay.
can we reserve that for Thursday night? Is that
Yes.
is that a good deal? Okay.
Yes.
So
Thank
on
you.
our Thursday power evening, I will make sure that we go over how to get out of a debit spread earlier than planned. So
Perfect. Thank you.
quick, awesome. Let's see. Let's talk about when's my next class? My next class, by the way, starts on the 23rd, 2 days from today, Monday. Monday is when it starts. So if you haven't signed up, I think I have a few more spots left on that. We started a class on the 9th, and that one is full. We have another one starting on the 23rd. So if you want to get in on that, you've got just this weekend to make up your mind or make a decision. Or take action, yes. Make up your mind, make a decision, same thing. So take action. Optionswitheddie.com. Hey, thanks, Mary, for posting that information there. All right, anybody else got some questions we can hit before we head out? Yes, no, maybe. Melis, who's Melis? Melis, how you doing?
Good, Eddie, and you?
I'm well, Melis. You know, optionista?
Yeah, I'm from Canada actually too.
Okay.
So it's the second time actually that I'm on a call with you. The first time was back in December.
Okay, welcome back. Welcome back. So today,
you.
Canada is well represented.
Mhm.
I can see Gail is over there as well, representing Canada. So very cool.
Yeah.
Thanks, Gail. All right, with that, hopefully this was interesting or added some value to your day, your Saturday. Thanks for hanging out with me. We do this every other Saturday. So today is the first Saturdays with Eddie of 2023. Obviously, I'm on vacation, but decided I'm going to go ahead and join you guys. It's been a while. We took a Christmas and a New Year's break. We're back on schedule. So every 2 weeks from here, right? Every other week we do Saturdays with Eddie. It is always at 11 o'clock. It is always free. Please, please, please invite your friends and family, and anybody who's paying $10,000, go ahead and invite them. No, it's not going to cost you $10,000, but
you're too funny.
But for you, Jacqueline, we'll make it 10,000. How about that?
I can hold it. I'm the one holding the 10,000 before it get to Mr. Eddie. So
the 10,000. Okay, all right. Yeah. 10K. If you have 10K to spend, you better have a good plan on how to make that 10K. So in my class, we are results based. We try to help everyone at least get return on their investment. Because this is not a hobby for a lot of people, 99%, I want to say, or close to 100%. We try to get results, and we do see results.
Eddie, let me inject on that.
Sure.
I'm one of your students, and you started teaching me in October, and by December I had doubled my account, and I was new to trading and into options. So yeah, thank you.
Awesome. That's a testimony. We hadn't even talked with Mary. Mary is a star student, and like you heard, she had no idea about options. Couldn't spell options for the life of her. Right? I added that last part. But yeah, thanks for that kudos. So I have, or we have plenty of students like that see good results. Obviously, you don't want to compare yourself with other people. You know, everybody has to work really, really hard. But we try to help you out. So I see Dami raised her hand there for a second. Dami, do you have a question?
Oh, no, I was just clapping for Mary. No, I didn't.
Oh, there we go.
It was the
All right.
reaction, like.
I see. All right. I got you.
Thank
So,
you.
Eddie,
yes.
even before when you were just doing, the online workshops, the verbals before you started your class, what you shared with us, and when I say us, I mean another group, what you shared with us helped us so much. It helped me so much. I made a lot of money just based on all the gems and tips that you shared with us, especially about Thinkorswim, getting on Thinkorswim. That made a world of difference for me, a world of difference.
That
And
is so true, Faith.
yeah, I mean,
Yeah.
you shared so much. That's why I jumped in and listened to you. And eventually, I'm moving to Florida end of this year and getting settled. I'm gonna jump back in just to take your class because I'll be free. I'm not free right now, but I'll be free. I have the time for you to do it, just to pick up all the gems because I mean I learned so much from you. We all did. A lot of us did. So I appreciate it, and it was free. It was free. So imagine what I'm gonna learn if I take your class.
Yeah, that's exactly right. The Saturday's class, as you just noticed, we were kind of all over the place, almost all over the place. But I wanted to hit a few fundamentals. I wanted to hit a few advanced topics. I wanted to, get some platform topics in. But the course itself is well structured. Takes anybody from fundamentals all the way to advanced topics and everything in between. We focus on doing things the right way. We focus on risk management. We're not so concerned about how much we make. It's how much we protect. And the net effect is that we grow. So we've seen students go from 0 all the way to even 100,000. We have people in the, those clubs there, they're making a ton of money. Again, results are not the same for everyone, right? You just have to understand that we've got some really, really good students, a lot of support. Even after you finish the class, there is a tremendous support. We trade live as well every once in a while, and we meet. We have a great community. So let's see. Samuel has a question. How about Samuel? How you doing? You there? Or is he clapping? I'm not sure now. Is he clapping, or do you have a question, Samuel? Maybe not. Okay. Very cool. All right. Well, thanks everyone for. Hey. Yeah. Did you have a question?
Yeah. No, I just want to ask you that you reserve some couple minutes for me after you finish the call.
Okay. Tell you what we will do is I will need to. Okay. Well, I'll just stop the recording and then we'll keep going. Is that cool?
Yeah, just what we have discussed on the email. I wanna talk about it. So just a couple minutes after you finish the call.
Say no more.
Okay.
Awesome. All right. Any other questions that anybody has, or how to proceed from here? Okay. Well, thank you so much. Happy New Year again, everyone. We'll see you in 2 weeks, and adios. Next week I will be in Atlanta, so this is the last or the next session rather. Yeah, the next session I will be in Atlanta, and hopefully I will have a better internet connection. Right. Adios.
Thank you, Eddie.
Thank you.
Thanks. Thank you, Eddie. Bye.
Safe trip.
Bye-bye. Thank you.
Happy New Year.
Happy.